Hello, it is Tuesday, the 30th of September 2008, and the terrible month of September has closed. I wanted to start here with a monthly time frame just to put this whole day here in perspective. Obviously, we had a big update today. The S&P gained 5 points or 4.5%, but looking at this big red candle, you can see that it's been a horrible month. In fact, for the month, the S&P 500 was down just under 10%. So it's really nothing to get excited about. We're still clearly in a downtrend. We've got the lower highs and lower lows. The market's gotten oversold, and yesterday I'd pointed out, in particular on the Nasdaq, some of the potential reasons why you might start to look for evidence of buying. But we had light volume yesterday, but today was even lighter. So we're right back up to this level where it broke down from. So really, it's just not a lot to get excited about. The volatility continues to be amazing, and really, it just puts the exclamation point on the fact that this is a trader's market. It's going to just drive anyone insane from a longer term standpoint, unless you have the stomach to tolerate it, which I doubt the people who do actually have any interest in listening to these videos. So I'll keep the perspective based on what we're looking at here, which is the shorter term time frames. The S&P 500, like I said, gained 4.8 $4.87 or 4.3%, and it's still down on the week. In fact, 3.5%. So just in 2 days, and today's only Tuesday, so we've still got a declining 5-day moving average. So the intermediate term trend means guilty till proven innocent. You don't trust these rallies. The only place that you would really be looking for any reason to be a buyer is on the 1 minute time frame. Let me just change the scaling so we can get rid of some of those bad prints in there. But the market started out as we know, with a gap higher. It saw some initial selling, but recaptured the daily VWAP there. It pulled back and tested that VWAP a couple times, and then at about 1:30, that's when the real buying came back into this market, and that's where we saw these higher highs and higher lows, and the market just continued to probably squeeze some shorts, the shorts that have shorter term time frames basically. Longer term, again, nothing has changed. We're in a horrible decline. Next potential level of resistance that ought to slow this market down is about that 118 level. We've got this prior support in there, as well as the declining 5-day moving average. So if you're buying in here, it might turn out to be the bottom. Only time will tell. And if you make good purchases in there, what your job is now is to manage risk. And you need to manage risk on the shorter term time frames until we have evidence on the intermediate and longer term time frames that the buyers are actually regaining control. And again, that evidence just isn't here right now. If we look at the 2-day time frame, though, you can see that the market is above the 2-day VWAP. So over the last 2 days, the buyers have actually regained control, even though we gap down. The average transaction during regular session hours, 9:30 to 4 p.m., that the buyers have regained control in the S&P 500. So a glimmer of hope, but it really just tends to be overshadowed by this larger decline, obviously. Let's take a look now at the Russell 2000. We didn't take a look at that yesterday. On the weekly time frame, we've got, obviously, this was the prior support that's been resistance numerous times. Actually, if we back it up to a monthly time frame, it's kind of disturbing here that it's looking like a big giant head and shoulders pattern, and that $63 level where we had seen support tested numerous times this year. It's about 63.5, 64. That's where the potential for a larger failure occurs in the Russell 2000, and we're in a bear market, so anything is possible here. Just focus on managing risk. Let's change the scaling here on the 30-minute time frame, and you can see where we are in here, up to a declining 5-day moving average, or pretty close to it, and nothing to be excited about there. Again, if you're long from today, I think that it doesn't make sense to hold overnight with all this indecision out there. And today was the Jewish holiday, so Congress was out and they weren't, getting things done. They have the potential to come in here and screw things up again. So let's not put too much faith in legislation and that sort of thing. Put your faith only in what pays you, and that is price. It's coming up to potential levels, near $69 a share where we had support, where we have that declining 5-day moving average. That prior support has the potential to act as resistance. breaking back down probably below 66 and a quarter or so. That's where I would say you want to get very defensive. And on the S&P, probably about 114 or so would signal that there's more serious selling in here. The financials, again, they're up to a declining 5-day moving average. This market's going to need time. All these moving averages crossing back and forth in here means indecision. Stage one, maybe it's accumulation in here on the daily time frame, but on the weekly time frame, there's really no evidence that there's a reason to be involved here. We still have these lower highs. Maybe we made a higher low, but it needs time to heal. That's going to be the dominant theme for this market for probably the next 6 to 9 months at least. And anyone can make those estimations of how long, how far. But here's, we need to see these moving averages start to converge. The short term moving up through the intermediate term, and what I was outlining yesterday, basically what occurred back here in late 2005. So let's take a look at the semiconductors. They bounced 5% as well. A lot of potential resistance up ahead for this market. Again, it's completely overshadowed even by yesterday's candle. And as good as a 5% gain is for one day, for the month we have this giant red candle, and this group was for the month down 13.5%. Year to date, it's down 24%. So this market just needs, I know I'm repeating myself, but it needs a lot of time to heal. I get a lot of emails saying, was that the bottom? That seemed like panic. It seemed like capitulation. I've been getting emails every time the market drives lower on volume throughout the year. But again, it's guilty till proven innocent. It needs time to heal only. So I promise not to say that again in this video. Gold was down $4.50 as measured by the GLD, maybe coming down to test this declining 50-day moving average. I had posted on my blog this morning the difference between the gold physical, which is represented by GLD, and the XME. The XME is the metals and mining companies, and they've just continued to get smashed. So don't look at it and say, what's wrong here? What's wrong here is that if you're buying gold mining stocks because gold has rallied, you're wrong. That's what's wrong here. Price is the only thing that pays. Price is truth, and the truth is this market, the mining stocks, are in a downtrend, and if you're fighting this downtrend, it's costing you a lot of money, and you can say it doesn't make sense or justify it any way you want. But again, only price pays, and you're just fooling yourself to think that the market cares about what your opinion of what the market should do. We looked at this yesterday, so we'll look at it again. This is the yield on the 13-week T-bill index. Yesterday it closed at 45 basis points. Today it closed at 90 basis points. So you get paid twice as much. Interest rates were up 100% today. As far as if you park your money, if you waited a day to park your money in 13-week T-bills, today you're getting just under 1% versus yesterday just under 0.5%. So I don't know how much you want to read into that. It's obviously been very volatile in here, and let's take a look at the NASDAQ now. The NASDAQ, I had pointed this out, and I'm not going to go into it as in depth as I did in a blog post about an hour ago, but we were looking yesterday at the Fibonacci level from this 2000 low, so we just dragged this mouse up here to the 2007 high. This Fibonacci 50% retracement, we had seen the 38.2% find support earlier in the year. It drove lower. I had put in that measured move and said that actually this is a reason to start looking only. We're at a potential area where we might find support. Today we did find support, but again, look at this monthly candle, huge red candle. But if you're a short-term trader, this market was up 2.8% today. 2.8%, so it clearly underperformed versus the SPY, which was up 4%. But still, this level for now, 37.18, that's the important low. And if that gets broken, then perhaps we'll go down to a 68.2% retracement. No one knows where the bottom is. We only know well after the fact. Focus on price action. And here what we're seeing in the NASDAQ again is that this market didn't bounce as strongly as some of the others did. Here on the 30-minute time frame, we can draw a little peak trend line off these peaks. Here we have this prior support Still way up at 40 and a quarter, and we're only just under $39. We've got a declining 5-day moving average, so a lot of work still needs to be done before it's clear to be buying for anything more than a day trade. But obviously, intraday, there's just some fantastic opportunities if you're quick, disciplined, and understand how to interpret the market action. And best place to find that is technicalanalysisbook.com.